Thank you for joining us on our webinar on another option to healthcare finance. My name is Dan Head and Chip Gibson. Over the next half hour, we will discuss why the traditional health insurance model is broken, why you should view your healthcare program long-term and not year to year, how employers can self-fund safely, and we'll introduce the benefits and our actual program, the Deland Gibson National Healthcare Program.
So the first thing is thinking long-term. And numbers can be pretty scary when you look at it over a 10-year span. So if you had a fully insured renewal premium of $1 million with 100 total enrolled employees, if it's trending at an annual increase of 9% a year, over the next 10 years, you're going to pay over $15 million. So what we try to do is have all of our clients look at the 15.2 number. Looking at the 12-month cycle, looking at an 80 to 120%, $120,000 increase is much easier to swallow than looking at 15 million. So with a more conservative comparison, if you have $1 million spend, and if it trends conservatively at 8%, your total spend over the course of 10 years will be about $14.4 million. Now, what if your plan can trend at 4%, which is conservatively in line with our experience of our program being 3 to 5% annually? So over 10 years, a 4% trend is equivalent to $12 million being spent. But the math regarding the difference between 4 and 8% is a lot better. In our program, you could potentially save up to $2.5 million over 10 years. Now let's get into stock prices. Taking an objective view of the major players in healthcare and how their stock has performed over the last 10 years and since the ACA was implemented. Many thought that the ACA was going to destroy profitability, but it looks like things are going all right. Now ultimately, these companies are in business to make money and to satisfy shareholders. This means profit. How and who they underwrite, the coverage they offer, and the network access they provide all strive to one goal: profitability. We often refer to these companies as healthcare financing companies rather than healthcare companies. So an analogy to make this work, we like to compare this to buying a car. When you go negotiate a new car purchase, you are trying to lower the cost of your car because that is what will have the greatest impact on your monthly payments. Now, when negotiating your healthcare renewals, you're not negotiating the price of healthcare or the price of your car, but you're merely negotiating on the percentage points in your loan and how to finance it.
Now, we have to provide healthcare, though. It's an important piece of a company's recruitment and retention strategy. So how can we deliver it? It really boils down into 3 areas in our minds, and that's fully insured, self-insured, also known as level funding, and then the program that we've built. Fully insured is what we're all comfortable with because it provides us with a fixed monthly cost, and it's great at covering large claims. Self-insuring is great at taking control and covering small claims. We've built our national program to combine the best of fully and self-insured healthcare. And so looking at fully insured renewal math, it's what we all refer to it as, fully insured. But here at Deland Gibson, we refer to it as fully deferred. Think back to the last time you switched insurers. What happened? The underwriter looked at your experience and came up with a premium they thought competitive to win you as a client. But what happened in year 2? They looked at your year 1 experience and came up with premium for year 2, and so on. The point being, you pay insurance premium for protection, and the insurer pays your claims. But they will come back in subsequent years to make up for your experience and any losses that they've incurred. Now let's start to go back the curtain a bit and see how they calculate your premium. There's your small claims from last year, which in effect you paid. You just did it via premium and handing off responsibility to the insurer. There's quote-unquote trend from the insurer's book of business and the increasing cost of healthcare, also known as inflation. There's their pooling charges for them to build up protection against large claims and for reinsurance. And then there's the administrative expenses to operate your plan, to print ID cards, to print and distribute summary plan descriptions, to provide customer service.
So who is self-insured? Well, a large employer is self-insured because they can. Why would Apple, now recently Amazon, Berkshire Hathaway, and JP Morgan ever pay someone else to take on their healthcare risk? Because they know they can save money in this and provide a better benefit for their people. It's hard for small employers because it's too risky and too volatile. For medium and small employers, this is volatile because stop-loss contracts can change with a few factors. First, your deductibles can change on an annual basis. The next and more scary aspect is lasers. If someone in your operation were to come down with a long-term and expensive condition, such as dialysis, needing dialysis or having end-stage renal disease, the stop-loss company knows there's going to be a large exposure. And what they do is they carve out future years on that exposure, which the employer gets stuck with. So if you started with a $25,000 or $50,000 deductible, they could essentially laser out that employee and then put a $600,000 or $700,000 deductible on that one specific situation. Now, digging into the details of what is behind self-funding is stop-loss. This is the insurance contract for the larger claims. In self-funding, you pay your small claims to a point per individual, let's say $25,000 to $75,000. At which point, after it pierces that number, specific stop-loss takes over to pay the claim. But you also have a total annual spend. If all of those claims in a year add up to surpass your aggregate stop-loss threshold, the stop-loss then kicks in to pay the remaining claims of the calendar year. Now, this is effective in lowering overall healthcare costs because employers are paying for the small claims themselves. They're not having insurance pay for this, which is not an effective cost structure. To interject another car analogy, using insurance to pay for your small claims is like buying insurance for the money you spend on gas. Now, being in the risk management world, we often advise our clients, if it's a known expense, it is much more efficient to pay for yourself than to use insurance to finance it.
So at this point, you probably realized we built a program to combat the cost of fully insured healthcare and the risk of pure self-funding. Again, we think long-term, so focusing on the long-term risk and volatility of fully insured versus self-funding versus our program, you'll see the following. Now, within fully insured, over multiple years, nearly all claims are passed on to the employer, as well as regulatory and compliance risk and risk to increase in taxes. It's subject to large increases in premium each year because that fully insured carrier, they're providing you with a ceiling of protection. And in subsequent years, they're going to underwrite that previous year and pass it on to you in those subsequent years. Within self-funding, over multiple years, nearly all claims are passed on to the employer. Programs are often tilted to protect the carrier in bad years and let them share profits in good years. You're subject to large increases, though, in stop-loss premium each year. Within our national program, as Chip mentioned, there's no exposure to lasers, and groups members are more immune from large swings in stop-loss premiums and attachment points. Stop-loss attachments and premiums are relatively stable year to year due to the ballast of the group captive. And there's, again, no exposure to lasers.
Now here we're kind of peeling back the onion of where the money goes of your fully insured premiums. And in breaking down the cost, starting from the top, the day-to-day claims make up 30 to 60% of your premiums. These are small claims, and depending on depending on your levels, it could be at $25,000 or to $75,000 and below. Now, the next level is pooled claims. For fully insured programs, this is internal stop loss for, let's say, the Blue Cross Blue Shield, and it's their pooled book of business for large claims. And in self-insured programs, this is where the stop loss layer is. Now, the bottom layer is the administrative costs. So as Dan alluded to before, the admin costs are printing of cards, the customer service, the TPA, the billing, etc. And what we find is that profit is baked into every level. Now, on the admin side of things, since it's such a small portion, we are okay with leaving profit in there because it's harder to replicate and it's just a smaller component. But this leaves up to 80 to 90% of your current costs fattened by profits. Now our program has eliminated, as well as the self-insured programs have eliminated the profit on the day-to-day claims. The small claims being paid by the employer is a more effective way, more efficient way to spend money. Now on the pooled claims, this is where profit is still baked in on fully insured plans and on self-insured plans due to the structure of the stop-loss contracts. But we remove it in ours, and it just makes for a much more efficient model for employers long-term.
So the Deland Gibson National Program. We simply realized there's a problem within healthcare, and especially so for the medium employers. So we started looking around for a best-in-class solution. We vetted the group captive market, and we identified our partner as the right fit moving forward due to the autonomy incorporated in the captive for the employer members. And looking at really the statistics of our captive, the three major points that we want to hit on are that there's, again, no new lasers, and that's in perpetuity. And that's resulted in our group having the best stop-loss policy on the market. So again, as Chip mentioned, if somebody comes down with a significant illness, they are not lasered or excluded or targeted. They are completely protected. And that is strictly a result of our group bringing 140,000 plus members to the marketplace. So instead of being a company with, say, 200 employees, you now look like a company of 140,000 employees.
And another component to this is, as much as I wish that Deland Gibson was the exclusive broker for all 550 companies and 140,000 members, we are not. But we've been appointed, as we did due diligence on the program did due diligence on their consultant base and appointed Deland Gibson as the region's exclusive provider of this. Now, getting into the details of the program, I don't want to bore you because it's really going through this layer by layer would take too much time. But the big picture is that this is a very similar model to the self-funded slide that we discussed before, except we have inserted a captive layer where employers share risk for the medium-sized claims. This is effectively a shock absorber to allow for smaller employers to effectively self-insure without the same exposures of a traditional self-funded program. In jumping into how to control the cost of healthcare, not merely negotiate the financing of healthcare. These are different phases of wellness and cost containment. Now, don't be overwhelmed by this. This looks like it's a lot. It looks like it could be, a culture shock for your employers, but really we do it in a really non-invasive way. Year one, our only goal is to get used to the new program. There'll be savings merely from the way it's financed behind the scenes, removing the profit, and implementing a prescription drug program that goes along with it. Year two, just like Blue Cross does with Healthy Actions, the goal could be try to get people to go to the doctor. In year three, working with you as your consultant, we would mutually put together a culturally acceptable program for your employees. Now, this is something that would work with your team to use healthcare more appropriately and effectively. For example, we can implement medical bill reviews. This is a third-party thing, but the statistics show that 70% of all bills have a billing error. Now, if you can get someone to correct that, these are just small steps that we can take to lower the cost of healthcare.
We wanted to keep this webinar brief, but before we end it, we thought it'd be useful to touch on some of the common objections that we've run into as we've spoken to clients and prospective clients since introducing our program. And, first and foremost, many people think it sounds like too much work, and they're worried about how their employees will receive it. It's really, to be perfectly honest, it's not a lot of work at all, and it's where we factor in as advisors. It's our job and our duty to make this a seamless transition. And we think it's actually more work for a company to continue taking on 8-9% increases to their plan every year, to compromise coverage, to mitigate those increases, and then to deal with kind of the backlash from employees and overall culture within their company because they are compromising coverage. As far as how employees will receive it, we have a great case study within our program of a company that was very concerned with this. And so they transitioned and implemented the program, but they did not tell their employees. They kept the same network, they kept the same pharmacies, and it wasn't until year 2 that they told their employees, and they didn't run into any backlash at all.
So to jump in here, at the end of the day, our program is only changing the financing behind the scenes. It is not affecting the quality of care or the options of your employees.
And then just about, CVS and Walgreens, I just touched on it there with that case study. Pharmaceuticals and prescription drugs is a massive gray area within our industry. And, our partner has built a consortium for the program that still partners with CVS and Walgreens, but it's passing on 10 to 15% savings immediately.
Another piece that we like to talk about is how we are paid. And we find that it's not really in the best interest of our clients for us to get paid an increase when you get an increase. So we're paid on a fee. We work it as a per employee per month fee that's the same no matter how many, that only changes when you increase employers, not when you increase your costs. So we just feel it's a more fair model, and it keeps us honest to do what's best for you, not to allow for an increase and get paid more.
So that's the Deland Gibson National Program. We thank you very much for joining us. We're going to follow up via email with answers to the questions that we have within the chat area.
And thank you very much for tuning in.